Netflix is currently trading at $109.19, down 81 cents or 0.74% on the intraday session. Watching the tape right now, we are seeing a classic tug-of-war at this psychological level, with the stock hovering just below the $110 resistance line that has capped momentum for the last 3 trading sessions. The volume profile this morning is slightly thinner than the average established over the past quarter, suggesting that institutional players are keeping their powder dry ahead of the upcoming holiday viewership data. While the red percentages on your screen might suggest a moment of weakness or a cooling-off period, the tape tells a different story, one of consolidation rather than capitulation. You might expect, given this intraday dip, that the market is finally waking up to the valuation concerns that have plagued the bears for the last 18 months. The prevailing narrative in the comments sections and the Discord groups is that the post-split excitement has faded, and we are now left with a mature utility company that has no more growth levers to pull. The expectation is that with the subscriber count stabilizing, the stock should naturally revert to a lower multiple, essentially trading like a boring cable provider from the early 2000s. The reality, however, is starkly different and far more aggressive. What you are seeing today at the $109 level is not a lack of growth, it is a repricing of risk. The market is currently digesting the transition from Netflix being a subscriber growth story to an inventory growth story. The drop you see today is arguably a bear trap, ignoring the massive efficiency gains from the ad tier integration, which has effectively turned the platform into the single largest premium television advertising network in the world. While retail traders are panicking over a fraction of a percent drop, smart money is looking at the average revenue per member metrics, which are quietly decoupling from the subscriber count in a way that most legacy analysts have yet to fully model. Let's strip away the noise and look at the chart structure. The stock is currently testing the lower bounds of a consolidation flag that formed right after the 10-for-1 stock split execution. This $109 zone is critical because it represents the previous breakout level from 2 months ago. When a stock retests a breakout level and holds, it often converts that old resistance into new support, a floor that allows for the next leg up. The price action we are seeing today, this slow grind lower on low volume, is typical of a shakeout. It is designed to flush out the weak hands, the investors who bought the split news hoping for a quick lottery ticket and are now bored because the stock hasn't doubled in a week. Comment below with the number of shares of Netflix you currently hold and if you bought before or after the 10-for-1 split. I want to see how many of you are holding through this consolidation phase. The broader context here is the streamflation fatigue that everyone predicted would kill Netflix, which has actually done the exact opposite. The expectation was that as prices rose, people would cancel. The reality is that Netflix has such deep pricing power that they have successfully forced the industry to bundle around them. They are not just a participant in the streaming wars anymore, they are the arms dealer. The recent data on the ad tier adoption shows that churn is actually lower among ad-supported users than premium users, a counterintuitive statistic that changes the entire risk profile of the stock. When you buy NFLX at 109, you aren't buying a media company. You are buying a data utility that has successfully captured the attention economy. Let's talk about the elephant in the room that the bears love to bring up, the live event risk. We all remember the Jake Paul versus Mike Tyson fight from last November. The expectation was that the technical glitches and buffering issues would be the death knell for Netflix's live sports ambitions. The internet was flooded with memes, and short sellers piled in, convinced that the NFL Christmas games would be a disaster. The reality? That failure was the most successful stress test in streaming history. They served over 60 million concurrent streams. No other platform on Earth could handle that load. The market eventually realized that the buffering wasn't a bug. It was a symptom of unprecedented demand that linear TV simply cannot match. Today's price action reflects a market that has largely forgiven the technical hiccups and is now pricing in the massive ad revenue that comes with that kind of scale. From a technical analysis standpoint on the daily chart, the relative strength index is sitting comfortably in the mid-40s. This is no man's land, which is exactly where you want to be if you are looking for a sustainable entry. It's not overbought, where you risk a sharp correction, and it's not oversold, which usually indicates a broken fundamental thesis. The moving averages tell a similar story of stability. The stock is trading slightly below its 20-day moving average, which is acting as immediate resistance, but it remains well above the 50-day and 200-day lines. This alignment confirms that the long-term trend remains bullish despite the short-term noise. If you are a swing trader, you are watching for a close above $110.50 to confirm a reversal. If you are a long-term investor, this chop around $109 is likely just noise in a much larger upward channel. Now, we need to address the short-selling activity because this is where things get interesting for the retail investor. Currently, short interest in Netflix is hovering around historic lows relative to its float, but don't let that fool you into thinking there is no pressure. There is a specific class of valuation shorts that are currently active. These are institutional desks that are shorting the stock purely based on its price-to-earnings ratio, which sits in the mid-40s. They argue that a mature company shouldn't trade at such a premium. However, there is actionable data you need to watch. Keep an eye on the days-to-cover ratio. It has been creeping up over the last few weeks. If this number crosses 3 or 4 days, it implies that if a positive catalyst hits, say a surprise announcement regarding the WWE deal or better than expected ad fill rates, the shorts will scramble to cover, creating a squeeze effect that could launch the stock through the $120 ceiling. Furthermore, look at the borrow rates. While generally stable, we have seen sporadic spikes in the cost to borrow Netflix shares in the repo market. This usually happens when a large fund is trying to put on a quiet bearish position without alerting the broader market. If you have access to advanced brokerage tools, monitor the fail-to-deliver data. A spike in FTDs often precedes a forced buy-in event. For the average investor, the signal to watch is the options market. Right now, the put-call ratio is rising slightly, meaning more traders are betting on a downside move. This is often a contrarian signal. When the crowd gets too bearish, the market has a habit of ripping higher to punish them. Do you think the short sellers are right to question the valuation at these levels, or are they missing the bigger picture on the ad revenue potential? Comment your take below. Another layer to this analysis is the retail sentiment we are tracking across social platforms. On Reddit and X, the conversation has shifted from what to watch to how to trade. There's a growing realization among retail investors that the stock split has made options trading on Netflix far more accessible. Before the split, a single contract was prohibitively expensive for many. Now, with the stock at $109, the liquidity in the derivatives market has exploded. This added liquidity dampens volatility in some ways, but exacerbates it in others. The gamma exposure from all these new retail options means that if the stock starts to move, market makers have to hedge aggressively, which can accelerate the move. This is why we see these sudden 80-cent drops or spikes that seem disconnected from news. It's just the plumbing of the market adjusting to the new leverage. Let's pivot to the fundamentals of the business itself to ground this price action. Netflix is no longer just a subscription business. The introduction of the ad-supported tier was the most significant business model pivot since they mailed their first DVD. The bears will tell you that ad tier users generate less revenue. The reality is that in many regions, the average revenue per member on the ad tier is higher than the standard tier because of the ad load. They have effectively uncapped their revenue potential. In the old model, you paid $15 and that was it. In the new model, if you watch 5 hours of TV a day, Netflix makes more money from you than if you watch 1 hour. This aligns their incentives with user engagement in a way that the subscription-only model never did. Moreover, the paid sharing crackdown, which everyone hated, worked. It forced freeloaders to either monetize or leave, and the vast majority chose to monetize. This was a one-time cash injection that is now baked into the stock, but the recurring benefit is the extra member slots, which have high margins. The company has effectively cleaned up its user base, leaving them with a cleaner, more profitable cohort of subscribers to sell ads to. Looking at the competitive landscape, the great rebundling is underway. Disney, Warner Bros. Discovery, and Paramount are all scrambling to find a way to survive. They are bundling their services together to reduce churn. Netflix doesn't need to bundle with anyone. They are the bundle. This positioning allows them to dictate terms. When you see news about Netflix licensing content from HBO or other rivals, don't read that as Netflix needing content. Read that as rivals needing Netflix's cash and distribution. This monopsony power, where they are the biggest buyer in town, give them immense leverage over Hollywood studios, keeping their content costs controlled while their competitors bleed cash trying to keep up. We also need to look at the international story. While the North American market is mature, the growth in APAC is just getting started. The local content strategy, producing shows in Korea, Japan, and India that travel globally, is an arbitrage play. They produce content for pennies on the dollar compared to Hollywood budgets, and it generates global hits like Squid Game. This margin expansion is something the valuation shorts constantly overlook. They see a U.S. media company. The reality is a global production arbitrage machine. Moving toward the future outlook, the biggest catalyst on the horizon is the full integration of the WWE deal starting in January 2026.